I think if we just give a sort of short resume of what on earth's going on. Ah, dear. Right. Well, welcome to our next little sort of video clip where we're trying to actually make some sense of nonsense known as the global economy. And I'm here with Tom, a face I'm sure many of you recognize. Tom, how can we explain simply what on earth's going on at the moment?
Well, when you got the kind of world that we have at the moment, I think what you really need to do is to take a step back, draw a breath, and try to think a little bit clearly. What we have said for the last year is what we're going to have as a result of the debt that the West has piled up is lower growth, lower returns, and higher volatility as the governments who now are controlling the issues push us to the edge of a crisis and bring us back, and push us to the edge of a crisis and bring us back. And the markets are not going to like that. And that is what's going to generate the volatility. Underneath it all, we've got to figure out what's really going on in the economy.
Yeah, but the problem is, of course, you've got the governments, as you say, pushing us to the edge of it. But the trouble is none of us actually trust any of the governments, whether it's what we've seen in the United States or this various reactions from all the different nations throughout the Eurozone. There's no coordinated approach, it would seem.
Yeah. Well, the fundamental question has sort of bumbled from, ooh, the banks are in trouble, let's move the problem to the governments, and oh, okay, now we got it on the government's balance sheet, which is why the politicians are in charge now. And then the question of default, and we've seen it in several places in Europe, and we just went through it in the States. We're probably going to go through it again in Europe and again in the States over the course of the next couple of years. The question that will evolve is growth. So once you get to the expense side of the ledger, and you say, okay, I got a vague idea what I'm going to do with that. How are you going to generate some revenue?
But that's the point, though, isn't it? Because it's still growth. It's slower growth. It doesn't look as though it's recession, does it? We're actually seeing quite good figures coming out of corporates at the moment overall.
The good figures that we're seeing coming out of corporates are the earnings. And arguably that the earnings are being driven by cost reduction within the companies as opposed to top-line growth. And so cost reduction spells lower employment or higher unemployment. And so we have a recovery, which is really a jobless recovery right now. And it's the increase in jobs that's required in order to generate the revenue.
But companies can't keep growing just by cutting costs the entire time.
No, you can't. At some point in time, without technological change, you run out of room to cut costs. And so what's required is confidence. And unfortunately, the politicians are not instilling confidence right now. So they're not creating the background that allows us to get this growth. So the focus going forward is going to be, so where's the growth? And right now we're bumbling along in the Western world at numbers like 1%. So the difference between +1 and -1 is not a huge number. So the worry has been, ooh, are we going to have this little double dip? We figured during the course of the last year that we would avoid it. The politicians have handled the crises less well than we would have hoped. And by doing so, they've increased the possibility or the probability that we do go flat or maybe slightly negative growth.
So with all of this, therefore, our policy has always been to keep broadly spread across that asset allocation models that we've had. And that's worked in the past. Is that still going to be applicable over the next few months?
It is, and I think you have to look at your disciplines, your basic disciplines in a moment like this, Justin. When the pressure's on, do what you do it well. We have always taken a medium to longer term view. So at this point in time, when the equity markets are getting beat up because of the uncertainty, would you rather be in an equity yielding 3+%, or in a government bond yielding 2-something, or in an index-linked security with a negative current yield on it, or in a commodity with no yield on it? So if we are going to basic investment discipline, yes, we do want that broad diversification, but I do think that over the medium to longer term, there is still a reasonable case for equities. I think we shouldn't panic. We should stay the course a little bit.
Yeah, I mean, it's always been a medium-term view. But one of the issues I think we've always highlighted as being one of the biggest risks, we can have a nice broadly spread portfolio, like great asset allocation, and then the currency goes wrong.
Yes.
That's the issue that I think has been sort of very fearful for many people. What can we do about that, and what are we doing about that?
Well, you start out with what's the currency of the liabilities of your customers, and of course, in our case, it's sterling. So we look at currencies versus sterling. The UK has got their own issues when it comes to growth, probably very, very similar to what you're looking at in the States. I think the issue with currencies in the 7IM portfolios is going to be that at the moment we have dollar exposure, about 15 to 18% in some of the portfolios. If the absence of growth means that QE3 is back on the cards, right, we think that would be very dollar negative. So what we're looking at right now is the probability of QE3. If we find ourselves in a QE3 situation, we're going to hedge a lot more of that dollar exposure.
Okay. So direction, therefore, during the August. Everyone's going on holiday. Headlines are still going to be fearful. What do we do?
Well, I think in the month of August, probably of substance, not a lot's going to happen. And what you find, of course, is the more people that go away on holiday in August, the lower the volumes you have in the market. And so it becomes easier for markets to gyrate in a very volatile way. And I think we have to be able to look through the month of August into the latter part of the year. If you look at equities in the FTSE context, they've been range trading for about a year now between 5,600 and 6,100 on the FTSE. And that's about a 10% trading range. So it's not the end of the world. After, mind you, in 2009, 2010, we had an extraordinary rise, of course, after the mess that we had in 2008. So we've had a very, very sharp rise for a couple of years. It's not unusual for markets to consolidate, and if you throw the uncertainty that the governments are heaping on top of it, no surprise that we have volatile markets. You're going to have to be able to look through the volatility, because trying to trade this volatility would get very expensive. And I'm inclined at this point in time to say steady, calm, stick to your disciplines, medium to long-term investment, seek out where the real longer-term value is, even though it's going to be choppy in the short term. Keep your discipline.
Yeah. Well, I think when you actually look at what's going on at the moment, we can all be frightened by the headlines. There will be some more scary headlines over the next month. For those going on holiday, I hope you have a good time, a good relaxing time. Try not to read the papers. Try not to be scared by the headlines. But also bear in mind, look through all of this to the medium term. Because what has happened in the past, that's actually been able to provide the sort of returns we need to have. So, Tom, thanks a lot.
Thank you.
And hopefully we'll be back shortly to give you an update on the next stage. Goodbye.